everybody. Thanks for joining us today. We have a really special guest, Spencer Levy from CBRE. He's going to be giving us his thoughts on the economy, how things are changing, what we all should be looking at and tracking. The way that this is set up, Spencer's going to give a little bit of an overview, and then it's going to be followed by a Q&A session with me, Spencer, and Vikram. Many of you have sent in questions and topics that you were really interested in learning about, and we really are excited to go over a lot of those topics today. Thank you all for your participation in the question.
And let me introduce my main man, Spencer Levy, guys. You're going to be in for a treat. So we were able to arrange for CBRE's Superstar. And if you don't know who CBRE is, it's the largest commercial real estate services firm on the planet. And we have the global client strategist and senior economic advisor for CBRE, Spencer Levy. He is really an expert in the space. He's been there for a couple of decades now. On top of him being a very amazing speaker and an entertainer in the real estate space, which is hard to find. Most people are really geeky and dorky. He has made bold predictions in the past. Many of them have come true. He can really take complex economic data and digest it and make it very actionable for investors, for institutions, and for firms such as ours. And the most important thing I want you to know is he uses a lot of movie references. So get ready to dig up your IMDb password. You may need it on this presentation. And with that said, guys, welcome my friend, mentor, and expert, Spencer Levy.
Thank you, Vikram, Chris, and team. And let's have a great discussion today. And I will try to get as many movie references in as I can, as well as shameless plugs for the Weekly Take, my podcast that I host. And if I don't get more than 5 in, I don't get paid today. So just be aware of that. So let's begin here. The big picture is this. The world is really in two halves. Half the world is fundamental, how commercial real estate is performing, which is excellent, particularly in multifamily. And the other half of the world is the capital markets, which is exactly the opposite. Really, really bad. Now, let's talk about this two-sided world for just a moment. So the reason why you're seeing excellent operating fundamentals in multifamily, when I say multifamily, I mean up and down the chain from Class A all the way down to Capital A affordable, which means government-sponsored housing, and single-family rental, if you want to put that in a different category, is because we have a shortage. If I could magically take 5 million units and just plop them down in the U.S. today, we still wouldn't have enough. And so because of that, even though we are going to have a slowdown because the consumer is going to get a little bit weaker, we are going to have a slowdown in building because it got really expensive to build because of interest rates, labor costs. Over the long term, multifamily is the place to be. It's the place to be because the fundamentals. It's the place to be because, notwithstanding the other side of this teeter-totter, the capital markets, it has the tremendous benefit of having two government-sponsored agencies, Fannie Mae and Freddie Mac, that are mandated to continue lending to it, even if we see illiquidity elsewhere. And unfortunately, we are. Because elsewhere, once you go outside of the realm of multifamily into industrial, data centers, retail, hotels, there is liquidity, but it's getting narrower and narrower and narrower. And once you get to office, it's extraordinarily challenging, even for the best sponsors, for the best assets in the best markets. And the reason is because the regulators are clamping down on the banks to reduce their office exposure. It's also because if you can get the loans, they're extraordinarily expensive, 500-600 basis points higher than they were 2 years ago, with much more onerous terms, much lower loan to value. And then you have this secular shift out there. And that's really the big question mark in office is, when are people going to come back? I mean, look, folks, hello, we're here in virtual land. You see that? Watch my hands go in and out. You see that? That's not how it's supposed to be. It's supposed to be me with you in person. Not like I was with Vikram in person in Boise, right? I like Boise, by the way. Boise is an underrated town. In fact, I had never been to Boise, not even once, until 3 months ago. Now I've been there 3 times, and I was invited for a 4th time. And I had my great Boise experience. I'm going to show you the picture if you want. There was a movie marquee of meet the cast of Napoleon Dynamite. I'm like, I thought people just made fun of Boise, Idaho because of Napoleon Dynamite. No, you guys embraced it over there. I thought that was hilarious. But in any event, the point is that you're seeing cities like Boise, their time has come. And why has their time come? Well, because of a couple of things. First of all, the big cities, the downtown areas, and some of the big cities you're hearing about, San Francisco, LA, New York, Chicago, really suffering. And they're really suffering because people aren't coming back at the levels that they wanted to. And it creates what we call a vicious cycle. And that vicious cycle is person A doesn't come back. The lunch counter downstairs or the deli downstairs closes. Bad elements walk into town, and it just feeds on itself. But you go to Boise, you go to Bend, Oregon. I love Bend too. I go there a lot. And you go to all these little cities, and this is where people are moving. So there was a political advisor for Bill Clinton. You probably have heard of him. His name is Jim Carville. He said that demographics is destiny. That's a quote, right? Well, I'm not a political guy, but I am a real estate guy. I can tell you this: in real estate, demographics is destiny. Because I was talking with Vikram and Chris just prior to this show. I'm like, look, I'd like all multifamily from A down to capital A, but I would rather have the worst asset in the best submarket than the best asset in the worst submarket. Why? Because the best submarkets will win, and the submarkets that are winning are changing, and they're moving into different places. They're moving into places that have a higher walkability score, live, work, play. They're moving into places that are closer to universities and hospitals. They're moving into places that have entertainment centers to them. So you go to a place like Salt Lake City, okay? And Salt Lake City, I like Salt Lake City. But you know what I really like about Salt Lake City? I like Silicon Slope, because Silicon Slope is just outside of downtown, and that's where they have the soccer stadium. And if you go to other places like that, where they have these entertainment venues, university bases, hospital bases, just outside Maine and Maine, you're seeing great stuff. But now let's not sell short the major cities just yet, because even in LA, San Francisco, Chicago, New York, a lot of these places have been redlined by my investors. Redlining is a term meaning they won't buy there, okay? That's a great opportunity to go in and buy in the best submarkets in LA, San Francisco, Chicago, New York, because these are places where they're going to have great New York and LA and San Fran are not going anywhere, folks. They're not going anywhere because they have so much capital. They have so much human capital. They have so much infrastructure. But they're going to change. New York's been changing for the last, 300 years, folks. And when I got into the New York City real estate business a long time ago, Midtown South, which is just south of Grand Central Station, for those folks who visit the city, was terrible. It was a sleepy little backwater market. And then guess what happened? Google moved in. And then they determined that the fiber that goes underneath the Hudson River for internet is right there. And boom, Midtown South is now better than Midtown. Whammo. Meatpacking District was terrible. Brooklyn, terrible, right? You can say the same thing about West Hollywood and LA. You can say the same thing about other neighborhoods and other places. So all I'm saying is this: demographics is destiny when it comes to picking real estate. But back to the macro economy for a moment before I take some questions. This is what our house forecast is. Higher for longer. Okay. I've been on calls like this, and I said the following. You ready? Here goes my credibility. I said, not only do I think inflation will be lower for longer, I think it will be lower forever. But that didn't work out so well. But guess what? I'm a stubborn guy. And because of these mega trends led by an aging demographic, reduced productivity, and we are hopeless on immigration, because for all of you Economics 101 students out there, growth is only two things: population growth plus productivity growth. That's it. That's the whole Econ 101 class right there. I don't see either of those things happening. I see an aging demographic. So yes, we are in this terrible blip right now of high interest rates, but we expect them to come down to much lower rates by 2025. And what does much lower look like? Right now, the 10-year Treasury, I haven't looked this morning, was around 4.3. It's going to get down to 3 or below by 2025. The short end of the curve, which was 5.25-ish, may go up one more time. but we think it will get down to 2 to 2.5% ish by 2025. Why does that matter? Well, it matters a lot. A, for the multifamily business, because cap rates and interest rates, while not perfectly aligned, there's a direct correlation between the two. And here's the other reason. When interest rates are high, alternative investments look pretty interesting too. And so that's what you're dealing with today. You're dealing with folks that have a more of a short-term way of looking at the world. Like, oh, let me buy this bond. Or are people that have a longer-term way of looking at the world. And the longer-term way of looking at the world, if you take a look at the data, private real estate outperforms stocks, bonds, and other real estate investment vehicles over any length of time. In the short term, you've got a real competitor. Over the long term, it's a great place to be, particularly multifamily for the reasons I laid out. Now, with that, I will take what other questions Vikram, Chris, and the audience is willing to throw at me.
All right, Spencer, that was awesome. I like that overview. I like the bold prediction and staying and doubling down on it with inflation and then the general trend of the interest rates. And along those lines, let's get into it. You mentioned a couple of trends: remote working, aging population, productivity decline. I want you to tackle another trend, which probably be a pervasive reality for all of us: artificial intelligence. Let's talk about how that affects real estate. Let's talk about how that affects the economy and even demographics and employment.
Well, it's affecting this call right now. I'm not really here. This is my
this is your virtual you.
This is virtual me. Actually, it's funny because the presentation I did in Boise, I used virtual me for part of it, just to make a joke about it. But here's the thing: AI, like a lot of other things, is not a new thing. It is a continuation of a trend that's been happening now for 200 years, which is the reduction in rote tasks and the increase in information economy, higher value add tasks. So yes, AI is going to impact certain rote tasks, and rote tasks, we can define them however you'd like, but these are things that are more things a machine can do. Anything that can be counted, a machine can do. Anything that can be reduced to numbers, a machine can do. But you know what a machine can't do? Can't negotiate a lease. You know what a machine can't do? It can't negotiate a purchase and sale contract. You know what a machine can't do? It can't negotiate a mortgage. You know what a machine can't do? Machine can't raise money. You know what a machine can't do? Most of the high value add things that we do in our business. And so the bottom line is, yes, there's more rote tasks that AI will do, but they're not writing Butch Cassidy and a Sundance Kid anytime soon.
Yeah, and within the AI realm, property tech, due diligence, transaction processes, selection criteria, content creation. That's a lot of that low to mid-level tasks. I think that's exactly what Spencer was talking about. But as the higher level tasks are there, so that's obviously human intellect. So with that said, let's get into inflation here. It cooled off recently. There was recently an uptick. The Fed is using that as a benchmark for their interest rate protocol. Where do you see things shaking out?
Well, the question really comes down to this. In the last event I did, the second to last event I did in Boise, because I've actually done two in the last month and a half, I was with Paul Ryan. And Paul Ryan is the former Speaker of the House, former vice presidential candidate. And it's easy for me to tell you what I think the Fed's going to do. It's a lot easier for him to say it because he's friends with Jay Powell. And I had 2 hours with him talking to him about this very topic. and it really comes down to the will of the Fed to hold the line. Because the line is, we're going to knock this economy down until it gets to 2% come hell or high water. By the way, movie reference, a great underrated movie. Anybody who's a Western fan, see Hell or High Water with Chris Pine and Ben Foster. Amazing. Any event. So the question is, will the Fed keep its foot on the brakes enough to squash the economy? And one thing you need to know about Jay Powell is he's not an economist. What does that mean? He's a lawyer, just like me, right? And so there's hope for us all. But what it means is that he is more of a politician than he is an economist when it comes to the math. And the politician in him is going to fold before the economics hawks get their way of saying, we're going to squash this thing come hell or high water. And that's for two reasons. Number one, inflation really is coming down. And there's some sticky elements to it, core inflation, and core inflation really comes down to, in part, housing prices. And those are lagging, so we know that's coming down already. But the other reason it's going to come down is next year's a presidential election. And the last time we had a major shift in Fed policy was in 1976. Why is that relevant? Well, of course, that's the year that Rocky came out, the best movie of all time. But that's also the year of the 76 presidential election, and the Fed did not want to be perceived as impacting the outcome of that election. So because of that, they folded, and they folded too soon. Now, that's the lesson that was learned, that they folded too soon and inflation ticked back up again. And well, that was the lesson they're trying not to repeat. But nevertheless, I still believe the Fed is still politically sensitive.
You know, one of the things that was actually one of my other questions about the election cycle. And there's some economists that say, hey, when they've done a macroeconomic view, it really doesn't affect outcomes in real estate or in interest rates. And then other folks are on your sidelines where they say, hey, there is some effect of election years on decision making for the Fed and et cetera. Sounds like you're leaning more toward that being relevant in their decision making process.
It's relevant in the short term, for sure. And so in the short term, it does influence Fed policy. But then, of course, in the short term, every time there is a new administration of a different party, you're likely to see a change in the environment, either through additional fiscal stimulus or through regulatory changes. And so there are short-term impacts of elections, but over the long term, I think, I hate to talk out of both sides of my mouth, but over the long term doesn't have major impact.
Based on recent negotiations in Congress, there's a statute or a legal discussion that's very important for our investors, which is bonus depreciation and cost segregation, and the sunsetting of that provision. Do you see that fading away over the next 4 to 6 years, or do you see that maybe being reinstituted as a valid tax haven for real estate investors?
Well, you should be aware that one of the many hats that I wear is I'm on the Real Estate Roundtable's research. I'm the chairman of the Real Estate Roundtable's research committee, and I'm meeting with the House Financial Services Committee on Monday in DC. So I see these people all the time and talk about all these things, right? And so we lobby for everything that's most beneficial to our business. But there are changes that are going to happen that are going to impact your reporting for private equity. And this is, you're deemed to be private equity for certain reasons. And certain tax provisions aren't going to go our way in the short term. They're just not. Now, you have to recognize that the House is controlled by Republicans and the Senate is controlled by Democrats. So it ain't law until it's law. But the question is what they can do legislatively or what can be done from a regulatory standpoint, because there are things from a regulatory standpoint they have liberty to do. So I think that in the short term, you're at risk. I'm not going to say, it's all going to be good. No, and you might lose that provision. But nevertheless, I think that over the long term, real estate has enough advocates on the Hill that you're going to see maybe not the same tax treatment, but still relatively favorable tax treatment of owning real estate versus other asset types.
That's awesome. That's good information to put into our decision making. You mentioned Boise, Idaho. You mentioned Bend, Oregon. You mentioned a lot of these sort of under the radar markets in the U.S. What are other top markets that people should be aware of as the next 12 to 24 months unfold?
Well, let me take a step back first, and I'll say this just in a somewhat academic way, and then I will get right back to your question. So from an academic standpoint, I've been in the real estate investment business for 30 years. And you need to understand that institutional investors, not only do they move in packs, but they are not allowed to invest in the Bend, Oregons, in the Boise, Idahos, in a lot of these smaller cities in the world. Now, some of that changes as these cities move up the size spectrum. So Salt Lake City, I was recently on a property tour with JP Morgan and MetLife. Okay, so there's some real groups going to these kind of cities. But nevertheless, a lot of these cities will not accept them. And so, or they can't go there. And the reason why they can't go there is because of illiquidity on the exit. On the exit, if they're not going in on the front end, they're not coming in on the back end either. Which brings me back to your question. So if you're a group raises a disproportionate amount of your capital from high net worth individuals and you syndicate, you have an opportunity to go into some of these smaller markets that the bigger groups won't. You say, well, if the bigger groups aren't there, why shouldn't I? Why should I go there? It must be riskier. Okay, that's going to be your thought process. The reality is in certain asset classes is true. Okay, in office, that may be true. It may be true in certain types of retail. It is not true in multifamily. It is not true in industrial. But in multifamily in particular, because multifamily is all about demographics and you are provided liquidity by Fannie and Freddie that nobody else gets. But here's the real beauty of those markets. If you're prepared to go to some of these smaller markets, like a Boise, and I can give you 10 other markets just like it, you're going to get a cap rate that's going to be 100 basis points or more lower, or actually higher. That's the way cap rates work. Higher cap rate means lower value than you would in a comparable demographic profile asset if it was located in or pertinent to a major market. So you take the identical multifamily building that's smack in the middle of Boise, is smack in the middle of the best area in Boise, and you pick it up and you stick it in the best submarket in Seattle. That Seattle multifamily deal will be 50 to 100 basis points more expensive.
Yeah, we actually saw this in reality. We're big into Atlanta. We have a lot of Atlanta assets. And as we were diversifying, especially during this interesting volatility, we noticed that we're getting like A-class 2018 built assets in like, markets that most institutions may not go into, like South Bend, Indiana, but it was the best asset in the best part of that submarket. And we got it for like a 6.5 cap. I was like, oh my God, it's amazing. And so we're starting to see some of that geographic arbitrage that you're mentioning, Spencer.
Well, South Bend, like you put South Bend in the same category as you'd put Ann Arbor, the same category as you'd put a lot of these other large college town, Bloomington. Okay. There's what did I say before we even went into this whole discussion? If you have a huge university base, there's a reason that these places are going to exist for a very long time, even if they don't have the same robust nature. Now, I will tell you, and this is coming from a guy whose son goes to Michigan, so I am biased, right? So I did a property tour with my son, I did a school tour with my son. We drove from Ann Arbor to Madison, Wisconsin to Bloomington, Indiana. There's a big difference between Madison, Wisconsin and Bloomington, Indiana. There's a big difference between a lot of the Boise and Ann Arbor. I mean, Ann Arbor is a great submarket, but Boise's got the state capital there too. So Madison's got the state capital too. You have to look at these durable industries when you're looking at your multifamily opportunities. And in like South Bend, I mean, look, you get Notre Dame isn't going anywhere. And so that's obviously a major driver there. But then the question is, who is your target audience, right? So Notre Dame's got professors, it's got students, but it's got, that's maybe 10% of the population. The rest is staff and people that service the university and others. And most of those people are renters. And that's why it's a great place to be.
Awesome. Let's talk about asset classes. Let's do a little pivot here. So I hear about these zombie shopping malls. We hear about, build for rent, which was really hot a little while ago, industrial, these life centers. Can you give us a little bit of sort of a smorgasbord or a little bit of a potpourri on these asset classes of different ones and maybe who's hot, who's not?
Wasn't that like one of Alex Trebek's favorite questions on Jeopardy? Potpourri. When they ran out of categories, let's go with potpourri. I guess we can go with a lot of other things like that. But anyway, so here's the quick rundown of the major asset classes. So the way we break down the asset classes are the big four and everybody else. Okay, the big four is office, industrial, multifamily, and retail. Okay, and then we have the everybody else, and the everybody else are the data centers, the life sciences, the senior housing, the senior family rental, the self-storage, other forms of specialty retail. Now, what is the major, and hotels is in that second category too. Why do we separate these two categories? Because, to quote somebody that I was quoting in the prior pre-call, Ron Popeil, who was the master of on television selling stuff, he said, set it and forget it. What does that mean? The big four asset classes gives you a much greater ability or much lower operational risk than do these categories where you have much higher operational risk. And so because of that, let's assume you have two buildings right next to each other. One is multifamily building A in South Bend. The second is the identical building, but it's designated as student housing. You know how they're going to price? I'll tell you how they're going to price. This one is going to price 50 to 75 basis points lower than this one. And the reason for it is student housing has more risk than does traditional multifamily. Why? Well, if you're not leased up on September 1st, you ain't going to be leased up on January 1st. In student housing and regular multifamily, you have a year-long leasing cycle. You're not as dependent on the university and all those other niceties that you don't have to deal with, right? So the smorgasbord is this. That's how real estate works. But from a capital markets perspective, certain forms of real estate are doing very well fundamentally today. And fundamental real estate right now is not as clean as these two categories. So the areas that are doing well, some of them are surprising. Retail is doing exceptionally well, open air retail, not second tier malls. Okay, second tier malls are a category that is under demolished, to use a term you hear a lot in our business. But open air retail is doing great. You know what else is doing great? Hotels. You don't believe me? Why don't one of you take one of your significant others on a trip this weekend to some fancy joint and see how much that room cost you? I just stayed in what must have been the nicest Courtyard by Marriott in Manhattan because it cost me $1,000. Okay, that's the kind of stuff that's going on right now. But in any event, so you have these two categories right now. Retail is doing exceptionally well, open air, not secondary malls. Hotels are doing exceptionally well right now. Office is a tale of two worlds. Office, the best stuff in the best submarkets, doing great. Record high rents, record high net effective rents. That means after leasing commissions, TIs, et cetera. But if you're a B office building, particularly in the B location, the worst is yet to come because most of those are going back to the bank, or a lot of them are going to go back to the bank. Some of them will be converted to multifamily. I had a call last week, and we believe that 10% of them could be converted to multifamily. Gensler recently increased its number to 25%. I don't know how they did it. In fact, I'm investigating it right now, but that's a tough place to be. Industrial, doing very well, but softening. We have a little bit of a supply problem coming online right now in industrial, but that's going to taper as people have put their pencils down as things have gotten more expensive. But where am I going tomorrow? When I say tomorrow, I mean tomorrow. I'm going to Boulder, Colorado, home of Deion Sanders, and we are going to go there and do a data center conference. Why? Data centers are doing incredibly well. Back to Vikram's question about AI, that's part of the reason why they're doing well, because there's great demand for them. But also what people don't know if they're not in the business is that rents in data centers were going down until about 3 years ago, and now they've been going up significantly. Why? Number one, great demand on a capital markets basis, great demand on a fundamental basis. But here's the one a lot of people don't know. It's really hard to build a new data center. And why is it hard to build a new data center? Because did you know that the average data center uses, wait for it, 20,000 households worth of water per day?
Oh,
Bump. So try building one of those in Phoenix, Arizona. And the point is that the existing ones are more valuable, but the problem with some of the existing ones, because we are trying to sell some for some really old ones, that some of them become technologically obsolete because of changes not dissimilar to what we just talked about a moment ago.
And Spencer, how do you feel about the combination of open air retail and multifamily and like a mixed use kind of environment?
I love it. And I'll tell you why I love it. Because, first of all, I got friends all over this business, but a lot of my friends are the biggest open air owners in the world, right? And every one of them, in every conversation I have with these folks, I say, what are you doing with your out parcels and multifamily? All of them, every conversation. And every one of them is either doing it themselves or they're bringing in a multifamily operator developer to do it for them. It's a great idea. And the reason why it's a great idea is because the best places to be right now, I'm going to be like a broken record, near a hospital, near an entertainment venue, or have walkability. Folks, I live in a beautiful house here in suburban Maryland, home of the soon-to-be world champion Baltimore Orioles. And the beauty of this house is I raised my 3 kids, my dog. It's a nice place. I can't wait to get out of here and go to a place where I can walk to my coffee shop and my restaurant at night, because owning in the burbs is overrated.
That's awesome. So yeah, we're looking at some opportunities with these life work play centers, and I think what you're saying makes a lot of sense. That's what people want more of.
100%. I mean, look, I would live in one of those places. If I stay in the burbs, I'm going to go to one of those. Okay. And I have right down the street from me. I can give you 10 old malls that are within 20 miles of where I'm sitting right now. All of them have become open air with multifamily. All of them. Right. But for my dollar, I'd probably go to some city, some hip, cool neighborhood in the city where I'm like, more I can hang out.
So there is capital, and a lot of people say there's a ton of dry powder sitting on the sidelines. Then there's some conversations about what is smart money doing? What's the institutional money doing? Can you sort of, and I think in the green room, we're talking about, foreign capital, either high net worth or sovereign wealth funds. So maybe you can sort of talk to us about where is money going?
Sure. So one of the stories I tell when I go to cities, and I was where was I last week? I was in Akron, Ohio. Okay. You know how many times I've been in Akron? Once. Okay. And I did an Akron Canton event. The reason I did that was I did it as a favor. I'd been to Canton once before because that's where the NFL Hall of Fame is. In any event, I was sitting with the mayor of Akron, right? And, these elected officials love me or they just hate my guts because I have one significant problem. I can't stop telling the truth, right? And I'm like, look, Mr. Akron, I was just in downtown Akron in your beautiful hotel. It was the nicest hotel in town. Every time I go to a city, I walk around and try to get coffee or something at night. It was a ghost town. There was nobody there. And when I say nobody, I mean, I'm telling you, I could have roller skated up and down that street and I would not have gotten hit by a car. But what's my point? Okay, my point here is this, is that people and money are mobile and they will go to the place where they have the best opportunity. Your city is immobile and you either attract people and money or you become a ghost town. When you look at capital, when you're dealing with sovereign wealth money, you're dealing with folks that can buy not just in city A or B in the US, they can buy city A or B in Asia, South America, Africa, wherever, in any industry, right? So you've got to make real estate particularly attractive to them as a direct investment, as an alternative to others. And look, right now, sovereign wealth, some of them are looking at the short term and some of them are looking at bonds. But in the long term, the opportunity in real estate is still excellent. And in the US, if the world gets crazier, and it's hard to imagine the world getting crazier, if the world gets crazier, the US looks even better. So you're going to see a lot more of that money coming here, even though going back to the DC thing, you're seeing some attempts to put additional restrictions on foreign money coming here for political reasons. When you're dealing with large insurance companies, that's where you're dealing with a denominator effect problem. Denominator effect is X% of their portfolio has to be in private real estate, Y needs to be in public real estate, and Z needs to be in bonds or something else. Those bonds or something else are looking pretty good right now. So insurance companies, while they're still lending, not a lot of equity coming out of them right now. And then you have the funds, the dedicated funds, and the dedicated funds are spending a lot of their time on asset management today. They all see the same thing coming out of my mouth, which is great opportunity to buy today. But what's happened over the last year is not only have they lost confidence that interest rates are coming down, I've lost a little bit of confidence because I have been wrong. Listen, I'm one of the very, very few people in my business that admits flaws, right? And the flaw is we thought that by this time we already see interest rates coming down. We're not. The economy has outperformed. But the point is that right now we're seeing consumers running out of money, the liquidity from the COVID crisis. We're seeing credit card receivables go up. We know that housing prices are going to come down because of it's a lagging indicator. So we think things are going to get worse. And while I don't want it to get worse from an American, I want everybody to thrive standpoint, from a real estate standpoint, it's a good thing because you need interest rates to come down to have a more vibrant market.
And since we're talking about distress, let's talk about navigating that distress. We know a lot of these rate caps are coming due. There's capital calls on some investments out there. And I've started to see, the more of the headlines, sensational headlines of like foreclosures by, either private groups or some institutions. Can you stack on that a little bit and maybe some of the concepts of sellers having pressure to sell some of these groups out there?
Well, I guess the one piece of good news, if there's a good news in the pile of bad news that's about to come, is that there isn't a bank in America that wants a single asset back in their balance sheet. They just don't want them. And because they're hard to operate, they get devalued. It hurts everything. It's just a disaster, right? Now, the regulators are also giving them liberty to kind of look the other way. It's called, if you put assets in a category called held to maturity, you're able to fictionalize its value, because if you were to liquidate it today, it'd be worth less. So regulators are giving you every incentive under the sun to work with these borrowers, right? Problem is some of these costs are so low that borrowers are just handing the keys back to the bank. So what do you do if you're in your position or anybody's position that's looking to buy today? I think that we are selling in the multifamily sector loans. We're selling loans in the office sector. And the bad news about the loans we're selling in the multifamily sector is we're selling them at pretty close to par, right? 90, 95 cents on the dollar. And you say, well, isn't there distress out there? Say, well, the underlying asset is still worth way more than the debt, even if the asset has been devalued, because operating fundamentals have been so strong for the last couple of years where rents have gone up 20% plus for a couple of years kind of thing, right? So how do you play it? Well, I would be playing it like this. I would be getting involved in every auction under the sun from every major brokerage house, from CBRE on to the others. And I would be speaking to other local developers, and I would be considering playing in other portions of the capital stack. So I just did a deal with one of my big clients where I did a workout where we had to, it was a multifamily, we had to stretch the Fannie Mae loan out as far as we could, Freddie Mac, excuse me. And then we got $80 million of preferred equity. And my client was jumping for joy that they lost $10 million. Why? Because if we didn't get involved, they would have lost 25. And the reason why they would have lost 25 is because they bought floating rate debt and the hedge came due. The hedge when they bought it in 2019 was $500,000. When it came due, it was $25 million. But we avoided them having to buy that hedge.
Speaking of, some of this workouts and things like that, and some of the transactional volume, I was chatting with your colleagues in Atlanta, with CBRE Atlanta, and we were having dinner with them, and they said, I think last year, they quoted they did 45 multifamily transactions in Atlanta, and then this year they're on track for 6 to 7, maybe 8. When do you see the uptick coming back?
I see the uptick coming back when interest rates are stable. when we know the Fed is done. Fed doesn't necessarily have to go down, but it has to stabilize. And until the Fed stabilizes, buyers don't know, the magic number. And the magic number is, what is the risk-free cost of capital? And so buyers just simply don't have confidence. And you also have these alternative investment opportunities look pretty attractive objectively. So you need interest rates to flatten and come down for you to see a material uptick in deal volume.
Chris, what questions do you have from all our investors out there?
I mean, honestly, I think, we answered 99% of the questions that our investors sent in. What I would, take this time to do is kind of go through the 5 key takeaways that, as listening to all these questions and listening to this webinar that I took away, and I know the investors would love to do this as well. I think one big one was, high net worth individuals, the retail investor base, they aren't institutions, and they shouldn't be acting like them necessarily. You take what you can from the smart money, you protect yourself, you hedge risk, but at the same time, there's opportunities operating where they're not. 2, there's markets, because of that being true, that are huge opportunities and should be explored by sponsors like Viking and by these high net worth individuals that really want to be able to take the opportunity at hand. I think one big thing that our investors are going to love, is optimism that 25 and 26 are going to have lower interest rates and are going to see decreased cap rates. So the folks that are buying right now are buying at huge value, and they're going to be able to, if they take the long-term approach, and maybe they're getting a little less cash flow than they want, but they're buying into assets that are extremely valuable if cap rates go anywhere near they were, during the last couple of years. And then, the last thing that, I really wanted to bring up was, folks need to kind of hold on, weather the storm, service their debt, continue to take advantage of buying things at a low basis, and, wait for things to come back to earth. Last note is, I know every investor asks me who to follow. And I think, for, Spencer, the shameless plug, it's the weekly take. You can listen to him every week, and he breaks down this information. And Viking wanted to bring him live and ask him these questions and give you a voice, but you can follow him every day. You should continue to do so.
And you can follow me on LinkedIn too. And sometimes I put funny references on there. So if you learn something about real estate, great, but you'll definitely be entertained.
Spencer, I got one more question. Last one. If you had $100,000, my friend, where would you put it?
$100,000? I would be buying Class B multifamily in emerging neighborhoods. And I would be buying it unlevered or at as close to neutral leverage as you can. And then backing up the CapEx truck, you're going to buy that stuff at like an 8 cap. And if you can, if it's really distressed, and, ride the storm up. Follow, there was an expression from the movie, All the President's Men, follow the money. Don't follow the money, lead the money. And lead the money to the places where demographics are improving in different forms of housing. I also like single family rental. I also like affordable housing. All forms of housing is where I'd be. Brand spanking new Class A multifamily in downtown areas. They're going to perform fine, but I'm not as bullish on those as I am on some of the others.
Guys, well, there you have it. Thank you, Spencer. Thank you, Chris. Guys, hope you learned a lot from this discussion. You may want to listen to the replay again. Follow Spencer on the Weekly Take. Follow us on our Viking podcast, and keep getting knowledgeable so you can invest wisely. And until next time, guys, be phenomenal.